Good afternoon. Mark here. I'm joined with Jeff. We're both portfolio managers with Foundation Wealth. And it's been a while, so we thought we'd catch up and talk tariffs. So, Jeff, this is the subject that everybody's talking about. So I thought I'd like to get your thoughts about how these tariffs will affect the stock market.
Well, if they actually go through the 25% tariff on Canada, it would be a massively negative impact on the Canadian market, impacting GDP massively. And I don't think it can be stated how poor it would be received by the Canadian economy. The big what if, though, is what will actually be implemented. And so, from my point of view, I wish I could get myself into Donald Trump's head and know what was going to happen because obviously we could position the portfolios perfectly. But as of right now, the market is pricing in that it's not going to happen. And so it's really a day by day, week by week, see exactly what's being spoken about by the White House, by other politicians. And in my point of view is basically stick to your strategy, stick to what your asset allocation is, because the noise, the background noise, can make people make mistakes.
So I think noise is probably the best way to describe this. I consider all this stuff as noise, negotiation, fodder. What people don't understand about tariffs is that they might not necessarily be inflationary. So what we get is two types of tariffs. There's retaliatory, so that means, US gives us 25% across the board, Canada does something similar, and then consumers don't really benefit. I don't think that's what's happening here. I think what's happening is more of a negotiation type of tariffs. Now, the thing that people don't understand is people just think 25% across the board, that means I'm going to pay 25% more for everything that comes from the US. Now, what happens is tariffs have been used forever. Like we have tariffs against the United States. We have big ones. Like in Canada, like where I live, we're pretty close to the border. So people will literally go to the US, pick up milk, pick up eggs. It's very, very common. Why do they do that? It's because it's so much cheaper in the US, even when the US dollar is where it's at, which is very strong versus the loonie. And that's because of tariffs. So in Canada, I'm just looking at a list here. Tariffs against milk, 270%. Cheese, 245%, butter, 300%, chicken, 238%, sausage, 70%. This list goes on. So what I think is happening in the US is they're seeing all these tariffs and saying, Canada, US, China, India, you already have these massive tariffs against us. And our tariffs aren't as big against you. So let's even the playing field. So what I think is going to happen is they might say that we're doing this, 25%, whatever it is, but they're also saying, hey, this is not a long-term strategy. We're open for business. Come talk to us. If you're willing to reduce your tariffs, we'll be willing to reduce ours. So I think this is where all this negotiation happens. So it could be that, yes, at the beginning, we see inflation. Prices go up because there's tariffs. But after these negotiations, some of these big tariffs against Canadians, against the US, could come down actually. And actually that will stem the effect of it. So our milk could be cheaper, let's put it that way, or cheese and poultry, that sort of thing. So some prices will go down, some prices will go up, but it's all a negotiation.
And I
Stock
think
market.
I just want to jump in. I think that's what the market is pricing in right now, that it is a negotiation. And so it's not going to be a trade war. It's going to be
Yeah.
more of a prolonged negotiation. And that's why we're not really seeing the big market pullbacks that people anticipated with large tariffs. If we get the prolonged trade war, which is the absolute worst case scenario, that's when it would negatively impact the market.
So I also see that there's a distinction between the economy and the stock market. And I can see how tariffs could really affect the economy, which is terrible for employment and certain industries. But I could also see how they can benefit the stock market because that often when the economy does poorly, there's more liquidity that gets injected into the markets in terms of lower interest rates and programs like we saw during the pandemic where the economy was horrible, yet money was still afloat. So the distinction there, I think, is another thing that people miss. We feel horrible. Like the best time to invest is when people feel uncomfortable.
Absolutely.
And Donald Trump, the US, the media, everybody's purposely out there to make us feel uncomfortable. That's what gets hits. That's what gets attention. But historically, if you look at it from a stock market perspective, those are generally some of the better times to invest. Are you seeing opportunities in the stock market with all this volatility? Volatility goes down and up, so it's where are you looking?
So right now, I think there's less opportunity, being that we've largely invested most of our assets in the US, and the US market has done really well. I think we need to see prolonged periods of earnings growth continue to happen to warrant those valuations. Where the opportunities are more in like the Canadian market because it is impacted more by these talks and internationally. But even with that being said, we're not shying away from our US allocation. We still believe very strongly in the US, and that's where the bulk of our asset allocation is. It's just you're not seeing those screaming buys like a year ago.
Not in the US,
Yeah.
but like what we started doing over the last couple of weeks when this tariff rhetoric really was peaking, like that the weekend that they were supposed to be imposed, that week right before that happened, we started hedging back our Canadian dollar. So we've been purely US for most of our positions. We took off all of our hedges, and that really worked out well for us because the US dollar got strengthened. But now it feels like I feel like that might be turning over. So we started putting some hedges back, not 100%. We just did about 30 in some of our positions. But it's getting to the point where I might go to 50 or might even do more. So I feel like that's turning over. Haven't done it yet, but we're
Yeah.
at 30. Other places that I see could really benefit from these tariffs or what's happening in the macro landscape is Europe. We're seeing Europe doing really well. Europe was left for dead. Like everyone thought it was completely uninvestable. Same with China because of the war, energy issues, politicians, all these sorts of things. And now because we're starting to see themes or rumors that maybe the conflict in the Ukraine is coming over,
Yeah.
deals being made. It's expected that Europe will be a big benefactor from that, as well as expected to rebuild a lot of the Ukraine. Those types of deals, negotiations are going through. And same with China. China's, again, their economy is horrible, but the resolution, they'll probably be part of that, and they'll probably be negotiating there. So some interesting places that
For
have
sure.
been down from a valuations perspective. China, I'm still iffy on. Like they've had a little bit of a bounce, but they got so
Yeah.
much issues there. But Europe also seems pretty intriguing. So we do have international positions on our pools, and right now we have some defensive hedges on them. But now I'm sort of thinking maybe it's time to let these things run.
Yeah.
What about gold? I hear a lot of people talk about gold. What are your thoughts on that?
Well, before I jump to gold, I just want to say it's a great point that you made earlier that the economy is different from the stock market. And you're seeing that in Germany, where the German economy really hasn't been doing well for quite a number of years now, whereas the stock market's starting to turn over and the euro market's starting to do much better. And so it's not a perfect correlation, and often the economy is much different than the stock market. And so that's what portfolio managers like yourself and I have to look for. But for gold, I think gold is being a hedge against if there is inflation from prolonged trade wars or increased trade negotiations globally. People view gold as a safe spot. Trump has basically increased the value of assets that are viewed as safe. So not only gold, but Bitcoin is used as a hedge as well. And so it's a way for people to feel secure in their portfolios and safe in their portfolios by adding a little bit of an allocation. I think as long as there is this prolonged trade talk, gold is going to stay relatively high.
Yeah, for our gold positions, we've always held gold. And what we've done for the last year or so is before we rebalance, which means we trim profits when it starts going up. But for our gold positions, we did not do that. We're actually let it run for most of our miners position. And that's worked out really well for us. So gold has done very well. The miners are sort of playing catch up. There's some leverage opportunities there. But now that gold's hitting almost $3,000
Yeah.
US, we're thinking about actually, doing the opposite, right? Like now we're thinking about actually hedging back on the golds because they've ran a little bit far. We still think there's a lot of room for gold, but maybe we're not as aggressive on that front.
For sure.
Anything else you want to talk about?
No, I think this was a great update on basically the unknowns. Right now, there's a lot of unknowns in the market, and the market historically hates unknowns, but it seems to be cutting through the noise and figuring out what exactly is going on with these negotiations. As long as the market is comfortable with what's going on, I think it will continue to have a strong performance. If the noise gets too loud and we see those 25% tariffs implemented, I think that's when you're going to see the volatility.
If that were to happen, I'd be a buyer because the thing is, again, noise is expected to make us emotional as portfolio managers. We're supposed to set aside our biases and not act emotional and take advantage of valuations and things. But at the end of the day, we got Trump who's in. He's in control of this. It's not like this is a pandemic or something that's sort of out of our control that we're fixing. Like these are politicians, these are people that want to be reelected in Canada and US and Europe and everybody. It's all within their control. They all want stock markets higher, particularly Trump. Like when he does his little scorecard, he's looking at the stock market every day. He has
It might be his only scorecard.
Well, that's what he said that, right? So he's said it many times. I want the stock market higher. I want interest rates lower. I want the US dollar lower. And it's in his power to somewhat control these things.
Yeah.
So when I see that as someone like people who have essentially the same motivation for prices to go up, then that makes me feel great. What crashes markets is usually the unknown, the things that we don't expect, it comes out of left fields, and we don't have that. Now that could happen for sure, but the way we stand right now, we're all in control. And if these negotiations will happen, and then if it gets the rhetoric gets really bad and markets come off, those are to me are more of a buying opportunity because usually that's when the deals get made and then things go off to the races. And you see that like these things can turn very quickly. Like we don't invest in Russia, but simply a phone call between Trump and Putin and boom, stock market goes up. Like you don't want to miss those big reactions to the upward. So volatility, people get scared of it, but really volatility is good and bad. And most of the volatility historically has been on the upswing. No one complains about volatility when it's going up, just the downside.
Absolutely.
So interesting times, great catching up with you. And we'll probably chat again in another month or so.
For sure. Look forward to it.
All right. Have a good day. Bye.